of it
Okay.
into the calculation. But like I said, we'll discuss that in much more detail in the coming weeks. So what remains then is called revenue income. And the reason why it's important to distinguish between income of a capital nature and income of a revenue nature is basically because you need to determine at the end of the day how you're going to tax your income. And law is, I remember saying that it is as wide and as vast and as deep as the ocean.
Yeah.
We, the lawmakers, cannot possibly think of every single scenario that may come up. There is laws in place, but case laws then come in, or specific cases come in, and it's something that the lawmakers never made provision for in the Income Tax Act.
Okay.
It's a gray area in the Tax Act, and there needs to be that tussle between the taxpayer and SARS. And that is
to whose benefit does that work?
It depends. The one with the bigger muscles.
I was gonna say that sounds very convenient for the receiver of revenue. Like, well,
not really.
Technically,
kind of and not kind of at the same time.
Okay.
I mean, you've got individuals and corporates that have great legal minds behind them and can fight a matter right to the end and win. It's happened. But what tends to happen then after such an extreme fight between a taxpayer and SARS is that SARS or the lawmakers would go and amend the act to their favor.
After all that.
But they can't obviously just do that for the benefit of...
But isn't that shifting the goalposts?
I was about to say, they can't just do that. There needs to be some sort of basis.
You can't just shift the goalposts like, scoring too many goals. Move the goals.
There needs to be some kind of basis. But historically, we've seen cases go to the courts. A taxpayer wins, maybe on a technicality, maybe on a really sort of tangible matter, and we've seen SARS then change the goalpost, as you were.
Sure.
But how do we determine what constitutes revenue and income?
Okay.
So there are some very obvious streams of income that can be easily identified as revenue streams, like in the case of an individual, a working individual going to an employer every day, earning a salary. That is what they do day to day in order to survive. They earn that salary. So that salary income is income, and it would be taxed on using those progressive tables. If that individual has extra funds, they put them into a fund that earns them interest. That interest income would be taxed at those progressive tables. Things like rent, as well as royalties for a company. Big corporates that have franchises that charge royalty fees for the use of the imaging and they lay out, that royalty fee would also form part of a revenue nature. Now, where the gray area comes in is when we look at, for example, a company. If we look at a company that is buying and selling books, the sale of the books, the income that they get from the sale of the books, that is their core business. They sell books, they get money. The company needs then to pay tax at 28% of the profit from the sale of the books.
Right.
But if you look at an individual like myself, I love buying books. I buy books not to resell them.
To collect.
And I must be quite honest, I don't really buy books to read them. I once heard a saying that the hobby...
Do you just buy titles?
I love buying books. Just books. True. I love them.
You have to explain this. At some point, you're going to have to break this down. You just love buying books.
Love buying books. If ever you want to gift me anything, a book.
But you're not going to read it.
I might read it.
But chances are you're not.
But looking at my bookshelf...
Do you judge books by their cover?
I do. I do.
Guys, don't get a book for a birthday. Trust me. That thing will be brand new 25 years from now. With
But I mean,
with dust.
that is now the context of what we're talking about. I don't buy books to read and resell them. I buy books for keeps.
Right.
So I will keep it in a good, pristine condition because I value the book. And if I were to sell it for
You
any
value it
reason,
so much that you won't read it.
listen, I don't want to, I don't want to crease the pages. That's how much I
But
value
the
it.
book is written. The book is written. Help me.
No
please.
judgment, guys.
No judgment.
Judgment. We all have our own little things, and mine is books.
I collect cars, guys. I don't drive them.
You
I
see,
just park them in the garage.
you see, it happens.
And every Saturday, I wash and wax them just to look at them. Like, ooh. And every time I take the car key, I'm like, hey, don't you dare put that in the ignition.
Yeah.
I'm trying to preserve this vehicle.
I mean, that very example is to the car owner what books are to me.
But it's a book. Anyway.
So if I were to sell one of my books one day for any reason, and the proceeds of that sale would, in my hands, be capital in nature, because I never bought the book to resell them. That was never the purpose of buying the book. Unlike in the hands of a bookseller, that is their trade. They buy the books in order to resell it at a profit. So the same item, two different intentions.
Okay.
And that's how we get to how we tax. And that has been explored very widely in case law, which I want to explore and chat about the different cases that have led to this conclusion by the Revenue Authority.
Break it down.
So the cases that we are going to be looking at are quite old and quite dated, but the context of the material itself is what drives how tax is applied today.
Okay.
So the first case we're going to look at is a 1937 case.
That's a long time ago.
That is a very long time ago. My dad was not born yet.
My dad was 11 years in the making.
Oh, in the making.
He was still to come. I think my grandparents might not even have hooked up yet.
Yeah, so the cases are very old, but like I said, the crux, and in fact, if you have a tax case today in court in 2022, and some of the principles that come out of these cases come up in your case, these 1937 cases will be quoted, that this lawyer or this judge in this case quoted in 1937 that this is the precedent that is to be set. So we're looking at a 1937 case, CIR, it was then called, the Commissioner of Inland Revenue, versus a gentleman called Mr. Fisher. So the judgment in that case, and not to waste time going into the details of the case, but just to pull what resources we come out of with in the case, the judge then made two very profound statements which live today in case law, that income is what capital produces. And he also stated that income is the fruit as opposed to the principle, which is the tree. So he used the analogy of a tree which bears fruit, and the income is the fruit which you then pick from the tree, and that's what you live off day to day, as opposed to the tree, which is the capital, the structure which you use to produce the income, fruit. And if we can look at an example that would be much more easier to relate to, property. So if you buy a piece of property with the intention of holding it and earning rental income from it, your tree, as you were, is the piece of property.
Right.
The land and the building
yeah.
and the structure itself. And the fruit is then the rental income. So the fruit will be taxed on your tax table. So if you land on the 36%, the the rental income which you get will be taxed at 36%.
Got you.
And if somewhere along the line you decide to sell the property for any reason, the property would then, because you held it as the tree, would then be taxed as a capital gain. So at that reduced rate, which we will talk about in the coming weeks.
Okay.
It's a whole complex transaction or calculation. But if we look at property once again in the hands of a property agent, the property agent's business is to buy and sell property at a profit.
Mhm.
So same piece of property in the hands of a property agent, the sale of the property would then be taxed on the property's agent's percentage. So for the property agent, then that very same piece of property, the revenue that they get from it is then income versus capital for you. But then we obviously have to draw a line, because not all property held by a property agent would then be held for the purposes of buying and selling.
Right.
For example, their house that they live in, that house they bought in order to live and grow their family. So what I'm trying to explain is that it goes on a case-by-case analysis. It doesn't go just because you're a property agent. All property owned by you is revenue in nature. So you have to look at each specific case in its own merits.
Okay. And wherever it is, that's where you go check up on it.
That's
Sure,
correct.
Sure.
And then another case where, also another old case, a 1950 case, where the taxpayer here was Mr. Morrison. And again, the Revenue Authority, what we now know as SARS, was the Commissioner of Inland Revenue. This taxpayer was involved in what one would call an unconventional trade. So Mr. Morrison had a habit of gambling. So he would buy, I think in his case, he would buy horse racing tickets. And he did this habitually. He won some money, he lost some money. In one instance, he won a lot of money. And then the Revenue Authority wanted to deem that income revenue in nature. So they wanted to tax him as per
And he won this money.
He won the money, yes.
Mm.
So he fought and went to court with this, trying to explain that it is gambling, it's betting. He won it's not his trade, it's pure luck. But at the end of the day, they look at his history and that he gambles habitually, and he seems to have some kind of formula with regards
to a pattern
this.
of some kind.
A pattern,
I
yes.
get you.
So if we look at this in today's terms, we can look at things like the lottery. So how you play the lottery, and if you happen to win the lottery one day, would then determine how those lottery earnings are taxed in your hands.
How is the lottery taxed?
You need to go to case law. We need to look at your habits with regards to playing the lottery. Do you play it every single week? Do you apply some sort of strategy? Or do you just play once in a while?
Do you have an addiction? Are you overdoing it? That type of thing.
That type of thing.
Sure. Okay.
Is this something that you are pursuing as intensely as you pursue your job, for example?
That jackpot.
So literally, when we look at your job, you wake up every day, you wash, you clean up, and you go work for your salary, for your income.
Yes.
Do you apply that sort of consistency with the lottery? Or was that just a stroke of luck that you won?
I hear you. The lottery is tricky though, because you can't plan for it.
Very tricky. But I mean, the Revenue Authority must get what the Revenue Authority must get.
And what percentage of your winnings are taxed?
So if you are found to be trading, in inverted commas, in this gambling activity, it would go into your normal tax calculation, and it will probably push you up to the higher tax brackets. So if you're an individual who on a normal basis gets taxed on 18%, that lottery winning could very well push you into a higher income tax
Okay.
bracket, and then that would be the percentage that goes to SARS.
Sure. And when SARS calculates this,
Yeah.
you pay up upon receipt of this money or once a year?
So what would normally happen is you would file your tax returns and
Yeah.
you would make all of your declarations
Okay.
on your annual income tax return. So it's only on that annual income tax return once a year where then you would be liable to tax.
It must be pretty painful.
Very painful.
Winning the lottery and then having to be like,
But if you do find yourself in that situation where you won the lottery, maybe you win it now in February, I would encourage you to get in touch with a professional who can then advise you well in time before you submit then your tax return in July.
okay. And I shouldn't blow it before then.
And then we see you on this other program on TV.
On this other program. Yo, dude, you didn't even make it one tax cycle. Therefore, then
Speaking of that program, I actually saw snippets of this gentleman who blew his money, and then he came across somebody who was selling rats. These rats could. True story.
Are these the rats that go and fetch money?
Yes.
Oh no.
So as I imagine, I only saw that snippet, but I imagine he detailed all the transactions that he did and in blowing his money. And then his last transaction was literally the purchase of these rats. That's what he used his last 20K on, the rats, which were supposed to bring him more money.
Guys, please no. What kind of life problems do you have to have, guys? You spend 20 grand on rats. You're lost.
Yeah. But these things do happen. And then I see we're running out of time, so I'm not going to get into the other case.
Okay.
But what I do want to paint a picture for our listeners is, how do we get to a situation where your case, your matter with SARS gets to court? Because under normal circumstances, you'd be sitting behind your computer on SARS e-filing and filing your tax return.
Sure.
How then does your tax return land up in court? It's not as quick as filing a tax return and then you've got a court case. There are processes in between. So what would happen is you file your tax return with what you believe is true and correct. The SARS Revenue Authority may then conduct an audit or may be privy to some information that there's some declarations which you made incorrectly and may issue a revision of the return that you've submitted. That revision may be not in your favor, in which instance you then have an opportunity to object. So you file an objection, it goes through the objection committee within SARS, and they come up with a result. And if any party is unhappy with that result of the objection committee, so if SARS is unhappy, or if you're unhappy, you then take it up a level to the appeal division.
Okay.
Within SARS still. And then you appeal the matter. It goes to the appeal panel in SARS. Also, at the appeal level, you've got an option to appeal within SARS, or you've got an option to then take it to court and appeal in court, which then how it enters the court system.
So it becomes a civil matter.
Yes.
Okay.
So it goes through an appellate division in court, and you can take it all the way up to the Constitutional Court, depending on your fighting power.
Depending on your fighting power. Famous last word.
And I see we've got like a minute or two, so we can get into the case that I skipped over.
Yeah.
This individual held Krugerrands. So to explain for those of you who don't know what Krugerrands are, it's basically gold coins. So you've got an option as a South African citizen to purchase gold coins. But again, one would think that you purchase gold for wealth creation or wealth accumulation. But there have been cases where people have purchased gold and sort of held it to trade and held it to make a profit, because
and the price is very stable.
the price is very stable, but it does increase.
Yeah.
So there's been individuals who've held it for the purposes of trading it later at a profit. And there's been, like in this case, instances where the court ruled in the favor of the taxpayer.
Okay.
Which then takes me back to your original question. What happens? Who wins the case? So the court in this case ruled in the favor of the taxpayer. This individual, Mr. Null, he held Krugerrands with the intention of holding them for a long term. They looked at his records and how long he had held them, had he had opportunity to sell them, and they found that he did have opportunity to sell them many times, but he continued to hold onto them. And then all of a sudden, he urgently needed to purchase a car for his wife. So he sold his Krugerrands in order to buy the car for his wife. SARS wanted to argue that he sold the Krugerrands for a profit, and then he argued, no, I held on to the Krugerrands because I had the intention of accumulating wealth for generations that would come after me, and they had that tussle in court.
Which is what a lot of people do.
Yes.
Yeah.
And in the end, the court ruled in the taxpayer's favor that his intention shows that he did in fact hold the Krugerrands for wealth creation, and that he sold the Krugerrands to be able to buy a car for his wife, not to sell that at a profit.
I got you.
So it does happen.
Ladies and gentlemen, facts about tax, things you may or may not have known. It gets more and more interesting. I'm loving the case studies too, because they're taking us straight to things that really happen.
Yes.
It's not theory in that case. It's practical as ever.
Practical, yes.
Facts about tax every Wednesday, ordinarily at 11:35. Today we had to push it up a little bit because in about 10 minutes time, we'll be speaking to Nkosana Makate. He is the guy who's taken on the giant Vodacom.
The guy with the legal muscle.
The guy, not just the legal muscle, the guy who's showing Vodacom flames right now.
Yeah.
Like he is, him and his team are doing the most.
They are.
So we'll be speaking with him. There was a high court judgment in his favor yesterday, but we'll get into all of that when we speak with him. Fani, thank you so much.
Thank you so much for having me.
See you on Wednesday.
Yes.